good evening, traders from across the globe. Welcome to Short-Term Trading Live with Oscar's 679th installment of Short-Term Trading Live with Oscar, baby. Yeah. These videos are just going to keep coming at you. Do not forget, futures trading is risky and can cause substantial financial loss. Traders, we are filming this video on Wednesday night for Trading Thursday. That is February 3rd, 2011. What do we have on the board? We have bull flags and we have bear flags, traders. In fact, this discussion in this video tonight will be about bull and bear flags, topic one, and then number two, the bond market. So that's what I'd like to discuss in this evening's video. For you traders that have been looking for me for the last 5 days, I feel much better now. Thank you for your letters and all your fine thoughts. Boy, oh boy, do not get a stomach bug. It is ugly. Anyway, so we're back and feeling great and have done some homework. I'm here to say that traders, listen, a lot of talk out there about Egypt, and you know we all love the Egyptians, right? There's nobody here that doesn't love Egyptians as a race and as a people. But I got to tell you, the trading community is going to move on with or without Egypt. Here's the thing. The biggest thing that would be on the minds of traders, and I'm talking about pure trading and not people's feelings here, the biggest thing that's on the minds of traders is, will it disrupt the oil? Well, here's how it works. The world uses about 78 million barrels per day of oil. The Suez Canal, where everyone's worried about that Egypt probably could shut down if things get crazy, pumps out between 2 and 4 million barrels a day. I can't get that finger to come up. 2 and 4 million barrels a day. So let's think about this. If we need 78 million barrels a day to feed the world's oil thirst or hunger, and 2 to 4 million get knocked out of line, is that going to stop the world's markets? Is that going to make everyone race into 30-year bonds and buy gold really fast and get out of their stocks? I don't think so. What can really happen? Not a whole lot. Yes, people feel bad. Yes, some people are going to panic and get out of their investments. But most people recognize the world is big and we're going to continue on. So what happened early last week? The markets got hit into late last week as well. And there was a panic reaction. Now the world has stood back and have taken the market from the lows it made last week, the S&P market, and shot it all the way up to higher highs than we've seen since 2007. So, I don't know that you should be running for the hills because of Egypt. Again, nothing to do with the Egyptians, nothing to do with the people at all. This is not a people thing here. This is about trading. The markets will continue with or without Egypt. So, for you traders that are so worried of what's going to happen and are the bonds going to go crazy, let it rock and roll. Trade the markets, use your charts, trade what you see. Enough of that. Let's go. Bull flags and bear flags, traders. This is what I'm getting at, and you'll see why in a few moments when we do our chart segment. For you traders that are not aware of what a bull flag is, this illustration right here, let's call each one of these black bars a daily bar, a daily movement for the S&P. So the S&P is moving up, 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 up. We'll call it the S&P. And then suddenly it has a series of days where it slants towards the downside. Sometimes they're actually in a nice parallel channel. What happens when you get that is it is called a bull flag. And why? This would be your flagpole and this would be your flag right here. Flagpole, flag. What should happen when you break out of a bull flag? You should break out towards the upside, and that is what a bull flag does. Now, if you look at a bear flag, the bear flag is almost opposite. You have a market coming down, 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 and then suddenly it starts putting in a series of days where it starts to head up slightly, but almost in a flat fashion or in a little bit of a parallel channel. This is your flagpole. This is your bear flag. The end result should be a breakdown like this. So, bull flags, when you see them, you expect after the pullback a breakout towards the upside like we see here. And the bear flag, when you see it run down and then have the sideways to upward slightly consolidation, you expect a downward move. Bull flag, bear flag. End result of a bull flag is breakout towards the upside in most occasions. End result of the bear flag is breakout towards the downside in most occasions. So, we have bull and bear flags on the charts that we are about to show you. Where do we have those flags? In the bond market, traders. We have those flags in the bond market, and they look like they are about to tell us something. So I'd like to show you those flags. Traders, what I'm showing you here is a very simplistic view, but is very good for you to use because it's a solid piece of information. Look for your flag and expect higher in bull markets. Look for your bear flags and expect lower in bear markets. Might seem simple. It'll keep you in tune with where a market's going overall. So you got that going on. In this video, I'm going to show you why. Traders, why I'm mentioning this to you is that because I have an Omni Camp, one ticket opened up. So we still have one seat open for Omni Camp. And that's coming at the end of this month. It's February 25th, 6th, 7th, and 8th. If you would like to come to my Omni Camp, where not only will I teach you about bull and bear flags, I will teach you how to call tomorrow's numbers today. If you come to my Omni Camp, if you'd like to come, simply click the banner link at my site, fill out the application, I'll give you a call. There's one ticket that just opened up. All right, so back to the flags. So in my charts, I'm going to show you why I think it is important to speak about the bond market and the bull and bear flags. And with no further ado, let's go look at some charts. Okay, traders, what you are looking at is the 30-year T-bond chart. It is a daily chart of the March contract. So it's the ZBH11, sometimes known as the USH11, but it is the daily bar chart of the 30-year bonds. If you'll recognize this average, it's one of our Omni proprietary averages. You will see that when the market is above it, it clearly stays above it, but once it gets below, it has a very difficult time ever getting back up. On the way down, we created a series of flags, but this big flag is here. The bonds tried to get above, once again, that average, and then just proceeded to head right back down. Right now, you have a well-defined bear flag. You are sitting right here, testing the lows of that bear flag. If this is the bonds moment, then this week we fall out of the bear flag and continue on down. The only other scenario that could happen here is if we just stay within the flag for a little longer and eventually work our way down. But we are in a well-defined bear flag, another failure at one of our Omni proprietary averages. And if we break from here, the big drop comes. So I like what I'm looking at on this chart. But let me show you another. Okay, traders, we're now looking at the very same market. This is the bond chart, but it's a continuous chart, so it shows a long time back where the bonds were. On this chart, you'll recognize the bull flags, the ones I showed you that look a bit like this. You will recognize that when we created bull flags on the way up, bull flag, breakout to the upside, bull flag, breakout to the upside, bull flag, breakout to the upside. On the way up, bull flags are what you would expect, and you get the upward action. On the way down, bear flags get created. A bear flag here, breakdown. Bear flag here, breakdown into the big bear flag that we are at right now, and we are expected to break down eventually through that one as well. Could be as early as this week. Traders, if you'll recognize here, there was the first bear flag that formed at the top was here to here. You finally put in your first bear flag. Then from there, you put in this one. And then from there, you put in this one. And then from there, you put in this one. Do you see the pattern, traders? Another bear flag will be created down below this one as we start to head lower. So you've seen the daily chart of the March contract in the bonds. Then you see the continuous contract, which has bull flags on the way up and bear flags on the way down. Let me now show you another chart of the bonds. Okay, traders, you've seen this chart in many videos. If you recall, we started to use this chart back when we called for the top in bonds a few months ago. Traders, here's what we've noticed. Huge head and shoulders on the weekly bond chart. Then we go up for a head test, which is a test of the middle to the top of the head of the previous Head and Shoulders. If you fail there, you know the top is in. We were able to call top, and we started to break down. Now we are below the OMNI average, and on a weekly, we have this target, which is down around 109, and we have this target. We are expecting the markets to go much lower. Of course, we have higher targets than that on the way down to achieve. You're looking at the 117 area, then the 114 area, then 109, and then even lower. That's where we expect the bonds to go overall as it marks time. But you can see it is clearly now creating a bear flag on the weekly below the OMNI average. Here's your pole, here's your flag. On the weekly, below the OMNI average. So what I have showed you here in bonds, even if there is some kind of a 1 or 2 day spike or even a week-long spike based upon what's happening in Egypt, overall, you need to be selling into those rallies because you need to be on the short side of bonds going through at least the first half of 2011. Traders, let's go look at another chart. Okay, traders, I'm showing you this one chart of the indices this evening because it has a bull flag on it. This is the NASDAQ daily bar chart in a wonderfully defined parallel channel heading towards the upside. So we're in a nice bull market. Interesting little bull flag we have here. Normally, I would look to call for a breakout of this bull flag. However, it's kind of small, and we are right at the top of the flag as of the settlement Wednesday afternoon. This is Wednesday evening. If we break back down, we can break down and stay within the flag, hit the bottom here, and head right back up. So I don't know which day we're going to pop out of this flag towards the upside. So we are going to take a neutral approach in the indices, at least at the onset of trading for Thursday. Why? We're in a nice bull flag, but the bull flag, we are right at the top of it right now. What happens at the top of a bull flag? You either break out, or you head back down, hit the bottom of the flag, and stay within it for a little while before the breakout comes. So that is why we are going to backpedal slightly in the U.S. indices for Thursday, and we are going to keep our eyes peeled on the bond market. So, traders, there's my technical argument for the bonds. We'll see what's going to happen with those. They certainly have proved to us that the top was in when OMNI said the top would be in several weeks back. We've been pulling back in those bonds. We are now in the bear flag. And if we break down under that bear flag, the next down leg begins. Keep your eyes peeled on bonds. Remember, there is what's going on in Egypt. So if you end up with some kind of a rally in bonds, if you're a long-term thinker, you sell into that rally and stay short going into 2011. All right, so traders, you know, many of my videos, I like to talk about stops, and I just want to remind you, a stop is your best friend in this industry. Do not ever put positions on without placing a stop. Place that stop first. Get the order in before you place the position. In other words, if you're thinking about going long S&P, put your sell stop in first. Then get long the S&P. Your protection needs to be in place before you get into a trade. Always place stops first. Come on down and join me at www.livewithoscar.com. Jump in my free trading rooms. Do not trade alone. Come on down and hang out with the army of Omniacs that's ever growing at my site, where I am at the helm working those rooms and teaching you to be a better analyst. Yeah, my voice is starting to go. I'm not going to make it for this video. I told you I've been under the weather the last few days. I didn't even get a whole video out of this day. It is my first day back. You know me, my dukes are up. All right, traders, so I guess I got to slip out of this before my voice goes completely. Make sure you come meet me at the site. Give me a call anytime day or night, 702-629-4755. Last but not least, the call, the OMNI call for 2011. Traders, I cannot wait to give it out. I've had another negotiation this afternoon about releasing that call. I'll let you know how that's going. I hope to get this call out to you very shortly. I am working on it. Anybody out there in television land, CNBC, Bloomberg, CNN, something of that style or that nature, if you'd like to have me on your show, well, I would give you that OMNI call right there on your show for the year. Please contact me. All right, I'm done. All right, traders, don't forget, keep your emotions out of trading. One of the best things you can do to help yourselves with that, say this to yourselves every morning, every afternoon, every evening, and you know what that is. Stops are in. Emotions are out. Always remember, futures trading is risky and can absolutely result in substantial financial loss. Traders, trading futures is not for everybody. It's not suitable for every trading account. And as always, past performance is not indicative of future results.